Session 1. Hello, aspiring directors, and welcome to the module on Key Managerial Personnel, KMP. In this session, we'll understand who qualifies as KMP, their important role in corporate governance, and the legal provisions governing their appointment and responsibilities. By the end of this module, you'll be able to define and identify key managerial personnel, understand the eligibility criteria for becoming a KMP, explore the role of the managing director as a KMP, review the provisions that govern KMP appointments. Let's get started and break down the role of KMPs in the smooth operation of an organization. The executive management of a company is in charge of the day-to-day operations of the company. Key management personnel was used to define executive management in the Companies Act of 2013. The key management personnel serve as the company's first point of contact with its stakeholders. While the board of directors is in charge of providing oversight, key management personnel are in charge of developing strategies and putting them into action. The legal and procedural aspects of the appointment of key managerial personnel, including managing director, whole-time director or manager, managerial remuneration, secretarial audit, and so on, are addressed in Chapter 13 of the Companies Act, 2013, and the company's Appointment and Remuneration of Managerial Personnel, Rules, 2014. According to Section 251, key managerial personnel, in relation to a company, means I, the Chief Executive Officer or the Managing Director or the Manager, Roman 2, the Company's Secretary, Roman 3, the Whole-Time Director, Roman 4, the Chief Financial Officer, v. such other officer, not more than one level below the directors who is in whole-time employment, designated as key managerial personnel by the board, Roman 6, such other officer as may be prescribed. Let us now discuss the different KMP's positions and their definitions under the Companies Act, 2013. First, we have the managing director. The term managing director is defined in Section 254 of the Companies Act of 2013. It states that a managing director is defined as a director who, by virtue of the articles of a company, or an agreement with the company, or a resolution passed in its general meeting or by its board of directors, is entrusted with substantial powers of management of the company's affairs, and includes any director who holds the position of managing director under any name. The explanation to Section 254 excludes from the substantial powers of management administrative acts of a routine nature when so authorized by the board, such as the power to affix the common seal of the company to any document, or to draw and endorse any check on the account of the company in any bank, or to draw and endorse any negotiable instrument, or to sign any certificate of share, or to direct registration of transfer of any share. Second, we have the whole-time director. Section 294 of the Companies Act, 2013 defines whole-time director as a director who works for the company full-time. Next, we come to the manager. Section 253 of the Companies Act, 2013 defines manager as any individual who, subject to the superintendence, control, and direction of the board of directors, has management of the entire or substantially the entire affairs of a company, and includes a director or any other person occupying the position of a manager, by whatever name called, whether under a contract of service or not. Fourthly, we have the Chief Executive Officer and Chief Financial Officer. Section 218/19 of the Companies Act, 2013 defined Chief Executive Officer/Chief Financial Officer as an officer of a company who has been designated as such by it. Finally, we have the Company Secretary. Section 224 of the Companies Act, 2013 defines Company Secretary or Secretary as a company secretary as defined in Clause C of subsection 1 of Section 2 of the Company Secretaries Act, 1980, who is appointed by a company to perform the functions of a company secretary under this act. Now, let's discuss the appointment of key managerial personnel. Section 203 of the Companies Act, 2013, read with Rule 8, requires the appointment of key management personnel and requires a listed company and any other public company with a paid-up share capital of 10 crores or more to appoint the following full-time key management personnel. I, managing director or chief executive officer or manager, and in their absence, a whole-time director. Roman II, company secretary, and Roman III, chief financial officer. Every full-time key managerial personnel of a company must be appointed through a board resolution outlining the terms and conditions of the appointment, including remuneration. An individual shall not be appointed or reappointed as chairperson of the company, as well as managing director or chief executive officer of the company, unless the articles of such a company provide otherwise, or the company does not carry multiple businesses. However, such companies engaged in multiple businesses, and having appointed one or more chief executive officers for each such business as the central government may notify, are exempt from the above. A full-time key managerial personnel may not hold office in more than one company at the same time, unless it is a subsidiary company. A full-time key managerial personnel who holds office in more than one company at the same time must choose one company in which he wishes to continue to hold the office of key managerial personnel within 6 months of such commencement. A company may appoint or employ a person as its managing director if he is the managing director or manager of one, but not more than one, other company, and such appointment or employment is made or approved by a resolution passed at a board meeting with the consent of all the directors present at the meeting, and of which meeting, and of the resolution to be moved thereat, specific notice has been given to all the directors then in India. If the office of any full-time key managerial personnel is vacated, the resulting vacancy must be filled by the board at a board meeting within 6 months of the date of such vacancy. Now that we know the various definitions, let's discuss the appointment of managing director, whole-time director, or manager. Let's break down the sections of the Companies Act 2013 that were mentioned, using practical examples for better understanding. First up we have Section 196, Appointment Restrictions. No company may appoint both a managing director and a manager at the same time. Example. Let's say Sunrise Textiles Limited wants to appoint both Mr. Arvind as the managing director and Mr. Rajesh as the manager at the same time. According to Section 196, Sunrise Textiles Limited cannot appoint both to these positions simultaneously. They must choose either Mr. Arvind or Mr. Rajesh, as the law prohibits the appointment of both a managing director and a manager at the same time. No reappointment of a managing director, whole-time director, or manager can be made for more than 5 years at a time. Example, Greenfield Technologies Limited appointed Ms. Priya as the managing director for a period of 5 years, starting in 2020. When her term ends in 2025, Greenfield Technologies Limited can reappoint her, but they cannot appoint her for more than 5 years in a single term. They must also ensure that her reappointment process starts no earlier than 2024, which is 1 year before the expiration of her current term. Next up we have Section 196(4), Approval Process Appointment of a Managing Director, Whole-Time Director, or Manager, as well as the terms and conditions, including remuneration, must be approved by the Board of Directors and the company in a general meeting. Example, Amkara Foods Limited wants to appoint Mr. Vikram as its new whole-time director. The board of Amkara Foods meets and approves Mr. Vikram's appointment and remuneration package during a board meeting. However, the appointment is not valid yet. The company must also get the approval of shareholders in its next general meeting. During the meeting, an ordinary resolution is passed by the shareholders, approving Mr. Vikram's appointment, making it final. If the appointment deviates from the conditions in Schedule V, the central government's approval is required. Example, if Lotus Pharmaceuticals Limited wants to appoint Mr. Sunil as managing director, but his remuneration exceeds the limits prescribed in Schedule V, the company must seek the approval of the central government. Even though the board and the shareholders approve the terms, the appointment cannot be finalized without government approval. If the appointment complies with Schedule V, central government approval is not required. Example, Harmony Solutions Limited appoints Ms. Radhika as managing director and ensures that her remuneration and other terms strictly comply with Schedule V. Since the appointment terms are within the prescribed limits, The company doesn't need to approach the central government for approval. Once approved by the board and shareholders, the appointment is valid. A notice convening the board or general meeting must include the terms and conditions of the appointment. Example: when Varun Enterprises Limited sends out the notice for its board meeting, it includes details about the proposed appointment of a new managing director, Mr. Sanjay. The notice mentions his proposed salary, perks, responsibilities, and any potential conflict of interest if other directors are related to Mr. Sanjay. This ensures transparency and that all directors are aware of the appointment terms before they approve it. A return form Mr. 1 must be filed with the registrar within 60 days of the appointment. Example: after Nandini Agri-Tech Limited appoints Ms. Shreya as its new whole-time director, the company must submit Form Mr. 1 with the Registrar of Companies, Row C, within 60 days of her appointment. If Nandini Agri-Tech fails to file this within the prescribed timeframe, they could face penalties. Finally, Section 196(5). Acts done by the appointee before approval if the appointment is not approved at the general meeting. Any acts done by the appointee before such disapproval remain valid. Example: let's say Maple Ventures Limited appoints Mr. Rahul as its whole-time director on January 1, 2024, but the company's general meeting to approve his appointment is scheduled for March 2024. In February, Mr. Rahul signs a major contract with a supplier on behalf of the company. If the shareholders reject his appointment in the March meeting, the contract he signed before the rejection would still remain valid and binding on the company, as his actions prior to the disapproval cannot be invalidated. These examples should provide a clearer understanding of the provisions under Section 196 of the Companies Act, 2013, in practical situations. There is a difference when the appointment is done with the approval of the central government. If a company fails to comply with the provisions of Schedule V of the Companies Act, 2013, an application for the appointment of a managing director, whole-time director, or manager must be made to the central government using E-Form No. Mr. 2. According to Section 200, a company may, while giving its approval under Section 196, consider the following factors when appointing a managing director, whole-time director, or manager. A. The company's financial position. B. The remuneration or commission drawn by the individual concerned in any other capacity. C. The remuneration or commission drawn by him from any other company. D. The individual's professional qualifications and experience. E. Such other matters as may be prescribed according to Rule 6. For the purposes of Item E of Section 200, the company must consider the following factors when approving the appointment of a managing director under Section 196. 1. The company's financial and operational performance over the previous 3 fiscal years. 2. The relationship between pay and performance. 3. The principle of remuneration proportionality within the company, ideally through a rating methodology that compares directors' remuneration to that of other executive directors on the board and employees or executives of the company. 4. Whether the remuneration policy for directors differs from the remuneration policy for other employees, and if so, why. 5. The directors' securities, including options and details of shares pledged as of the end of the previous fiscal year. That wraps up our Session 1 on key managerial personnel. We've covered the definitions, roles, and appointment process of KMPs, as well as the crucial part they play in executing a company's strategies while ensuring compliance with legal and regulatory frameworks. As future leaders, it's important to understand how the right KMPs help create a strong foundation for corporate governance and smooth business operations. Thank you for participating, and I look forward to seeing you in the next module as we continue building your expertise in corporate governance. See you soon. Session 2. Hello participants. Welcome to Session 2. In this session, we will delve into the critical aspects of corporate governance concerning key managerial personnel, KMPs. We will examine the disqualifications under the Companies Act of 2013, the reappointment process for managing directors, the essential functions of a company secretary, and the framework for managerial remuneration. Understanding these elements is crucial for ensuring compliance and fostering good governance within organizations. With regard to the disqualifications of KMPs, under Section 196(3), there is a specific prohibitory provision with regard to the appointment of managing director, whole-time director, or manager. This section lays down that no company shall appoint or continue the employment of any person as its managing director, whole-time director, or manager if the person is a. is under the age of 21 or has reached the age of 70. Provided, however, that the appointment of a person over the age of 70 years may be made by passing a special resolution, in which case the explanatory statement attached to the notice for such motion shall indicate the justification for appointing such person. Provided further that where no such special resolution is passed, but votes cast in favor of the motion exceed the votes, if any, cast against the motion, and the central government is satisfied, on an application made by the board, that such appointment is most beneficial to the company, the appointment of the person who has attained the age of 70 years may be made. B. Is an undischarged insolvent or has ever been adjudged to be an insolvent. C. Has ever suspended payment to his creditors or has ever made a composition with them. Or D. Has ever been convicted by a court of an offense and sentenced for more than 6 months. Aside from that, Part I of Schedule V contains 5 conditions that a person must meet in order to be eligible for appointment as managing director, whole-time director, or manager without the approval of the central government. These are the conditions. A. He had not been sentenced to imprisonment for any period, or to a fine exceeding 1,000 rupees, for the conviction of an offense under any of the following acts. I. The Indian Stamp Act, 1899, Roman II, the Central Excise Act, 1944, Roman III, the Industries Development and Regulation Act, 1951, Roman IV, the Prevention of Food Adulteration Act, 1954, v. the Essential Commodities Act, 1955, Roman VI, the Companies Act, 2013 or any previous company law, Roman VII, the Securities Contracts Regulation Act, 1956, Roman VIII, the Wealth Tax Act, 1957, Roman IX, the Income Tax Act, 1961, X, the Customs Act, 1962, Roman XI, the Competition Act, 2002, Roman XII, the Foreign Exchange Management Act, 1999, Roman XIII, the Sikh Industrial Companies, Special Provisions Act, 1985, Roman XIV, the Securities and Exchange Board of India Act, 1992, Roman XV, the Foreign Trade Development and Regulation Act, 1922, Roman XVI, the Prevention of Money Laundering Act, 2002, Roman XVII, the Insolvency and Bankruptcy Code, 2016, Roman XVIII, the Goods and Services Tax Act, 2017, Roman XIX, the Fugitive Economic Offenders Act, 2018. B. He had never been detained under the 1974 Conservation of Foreign Exchange and Prevention of Smuggling Activities Act. Provided, however, that where the central government has approved the appointment of a person convicted or detained under subparagraph A or B, as the case may be, no further central government approval is required for the subsequent appointment of that person if he has not been so convicted or detained subsequent to such approval. C. He has reached the age of 21, but has not yet reached the age of 70, provided, however, that if he has reached the age of 70 and his appointment is approved by a special resolution passed by the company in general meeting, no further approval from the central government is required for such appointment. D. If he is in a managerial position in more than one company, he receives remuneration from one or more of them, subject to the ceiling set forth in Section V of Part Roman II. E. He currently resides in India. For the purposes of the proceeding, a person who has been a resident in India for a continuous period of not less than 12 months immediately preceding the date of his appointment as a managerial person, and who has come to stay in India for the purpose of taking up employment in India or carrying on a business or vacation in India, is considered to be a resident in India. However, this condition does not apply to companies operating in special economic zones, as defined by the Department of Commerce from time to time. A non-resident of India, on the other hand, may enter India only after obtaining a proper employment visa from the concerned Indian mission abroad. Such a person shall be required to provide, in addition to the visa application form, a profile of the company, the primary employer, and the terms and conditions of such person's appointment. Now let's discuss the reappointment of managing director. Sections 196 and 203 of the Companies Act of 2013 define appointment as including reappointment. The managing director of a company must be reappointed before his term of office expires. If the reappointment of the managing director is approved but does not meet the conditions set out in Schedule V, the central government must approve it. The remaining provisions for reappointment of a managing director are identical to those for appointment of a managing director. So let's proceed to the discussion on the functions of company secretary. Section 205 specifies the duties of the company secretary as follows. A. To report to the board on the company's compliance with the provisions of this act, the rules enacted thereunder, and other laws applicable to it. B. Ensuring that the company adheres to the applicable secretarial standards. C. To perform any other duties that may be assigned. The term secretarial standards refers to secretarial standards issued by the Institute of Company Secretaries of India, which was established under Section 3 of the Company Secretaries Act, 1980, and is approved by the central government. For the purposes of Clause C of subsection 1 of Section 205, the central government has prescribed that the duties of company secretary shall also include 1. To provide collectively and individually to the company's directors such guidance as they may require regarding their duties, responsibilities, and powers. 2. To facilitate the convening of meetings and attend board, committee, and general meetings, as well as keep minutes of these meetings. 3. To obtain approvals from the board, general meetings, the government, and such other authorities as required under the provisions of the Act. 4. To represent the company before various regulators and other authorities under the Act in connection with the discharge of various functions under the Act. 5. To assist the board in the conduct of the company's affairs. 6. To assist and advise the board in ensuring good corporate governance and in complying with the corporate governance requirements and best practices. 7. To discharge such other duties as the board may assign from time to time. 8. Any other duties imposed by the Act and rules. Section 205, 2, states that the provisions of Sections 204 and 205 shall have no effect on the duties and functions of the Board of Directors, chairperson of the company, managing director, or whole-time director under this Act, or any other law currently in force. Now, let's discuss managerial remuneration. Incentives drive business managers in the same way that profits drive business. Not surprisingly, managerial remuneration is an important piece of the management puzzle in a fiercely competitive corporate environment. While it is critical to incentivize the workforce performing the difficult role of managing companies, it is also critical not to go overboard with the perks and pay. In India, the law intervenes to keep a check on unnecessary profit squandering by companies, while also ensuring adequate and reasonable compensation to managerial personnel. Let's get to the session wrap-up. In today's session, we have explored the disqualifications of KMPs, the nuances of managing director reappointment, the critical functions of a company secretary, and the framework for managerial remuneration. Understanding these topics is essential for fostering compliance and promoting effective governance in organizations. In our next session, we will continue our exploration of corporate governance by examining additional roles and responsibilities within the framework. Thank you for your participation, and I look forward to seeing you in the next session. Session 3. Hello, participants. Welcome back today. We're going to talk about how companies decide and manage the pay for their top managers and directors, as per the Companies Act, 2013. We'll cover important rules under Section 197, which sets limits on how much companies can pay their managing directors, full-time directors, and managers. We'll also discuss what happens if a company wants to pay more than the allowed limit, how directors can be paid for attending meetings, and what the company has to report about these payments in their board report. Plus, We'll touch on what happens when the company doesn't make enough profits, how directors' insurance works, and more. Let's dive in. Section 197 of the Companies Act, 2013 established a maximum ceiling for a public company's payment of managerial remuneration to its managing director, whole-time director, and manager, which shall not exceed 11% of the company's net profit in that fiscal year, computed in accordance with Section 198, except that the director's remuneration shall not be deducted from the gross profits. Furthermore, the company in general meeting may authorize the payment of remuneration in excess of 11% of the company's net profits, subject to the provisions of Schedule V. For the purposes of this section, net profits are computed in the manner specified in Section 198. The remuneration payable to any one managing director, whole-time director, or manager shall not exceed 5% of the company's net profits, and if there are more than one such director, the remuneration payable to all such directors and managers taken together shall not exceed 10% of the company's net profits. Unless approved by the company in general meeting, the remuneration payable to directors who are neither managing directors nor full-time directors shall not exceed the following. If there is a managing or full-time director or manager, the fee is 1% of the company's net profits. Otherwise, the fee is 3% of the company's net profits. The aforementioned percentages are exclusive of any fees payable to directors for attending board/committee meetings or for other purposes as determined by the board. When it comes to remuneration by a company that has no or insufficient profit, the company shall not pay any remuneration to its directors, including managing or full-time directors or managers, except in accordance with the provisions of Schedule V and, if it is unable to comply with Schedule V, with the prior approval of the central government. In cases where Schedule V applies due to a lack of profits or inadequate profits, any provision relating to the remuneration of any director that purports to increase or has the effect of increasing the amount thereof shall have no effect unless such increase is in accordance with the conditions specified in that schedule, and if such conditions are not met, the central government's approval has been obtained. With regards to the remuneration to directors in other capacity, this falls under the ambit of Section 197(4). The remuneration payable to directors, including managing or full-time directors or managers, shall include remuneration for services rendered in any other capacity, with the exception of the following. A. The services provided are of a professional nature, and B. The director, in the opinion of the Nomination and Remuneration Committee, if applicable, or the Board of Directors in other cases, possesses the necessary qualification for the practice of the profession. The sitting fees to directors for attending the meetings falls under the ambit of Section 197(5). A director may be compensated in the form of a fee for attending board/committee meetings, or for any other purpose determined by the board, provided, however, that the amount of such fees shall not exceed the amount prescribed. The central government prescribed through rules that the amount of sitting fees payable to a director for attending meetings of the board or committees thereof may be as decided by the board of directors or the remuneration committee thereof, but shall not exceed the sum of artices 1 lakh per meeting of the board or committee thereof. Other than full-time directors, the board may set a different sitting fee for independent and non-independent directors. Now let's discuss the monthly remuneration to director or manager. According to Section 197(6), a director or manager may be paid remuneration in the form of a monthly payment, a specified percentage of the company's net profits, or a combination of the two. Section 197(14) states that any director who receives a commission from the company and is a managing or whole-time director of the company shall not be disqualified from receiving any remuneration or commission from any holding company or subsidiary company of such company, subject to the company disclosing such compensation or commission in the board's report. So what happens when remuneration is drawn in excess of prescribed limit? According to Section 197(9), if any director draws or receives, directly or indirectly, any such sums as remuneration in excess of the limit prescribed or without the prior sanction of the central government. Where required, he shall refund such sums to the company and hold it in trust for the company until such sum is refunded. Section 197(10) states that unless permitted by the central government, the company shall not waive the recovery of any sum refundable to it under subsection 9, mentioned, with regard to the insurance premium as part of remuneration. When a company takes insurance on behalf of its managing director, whole-time director, manager, chief executive officer, chief financial officer, or company secretary to indemnify any of them against any liability arising from any negligence, default, misfeasance, breach of duty, or breach of trust in relation to the company, the premium paid on such insurance shall not be treated as part of the remuneration payable to any such person. However, if such person is proven to be guilty, the premium paid on such insurance shall be treated as part of the remuneration, according to Section 197(13). Now, let us proceed to discuss the disclosure of remuneration in the board report, which falls under Section 197(12). Every publicly traded company must include in its board report the ratio of each director's remuneration to the median employee's remuneration, as well as any other information that may be required. The central government mandated the following disclosures by a listed company in its board of directors report via rules. I. The ratio of each director's remuneration to the median remuneration of the company's employees for the fiscal year. Roman 2. The percentage increase in remuneration of each director, CEO, CFO, CS, or manager in the fiscal year. Roman 3. The percentage increase in the median remuneration of employees in the fiscal year. Roman 4. The number of permanent employees on the company's rolls. Roman 8. The average percentile increase already made in the salaries of employees other than managerial personnel in the previous fiscal year, and its comparison with the percentile increase in managerial remuneration and justification thereof, as well as any exceptional circumstances justifying an increase in managerial remuneration. Roman 12. Confirmation that the remuneration is in accordance with the company's remuneration policy. The board's report must include a statement listing the names of all company employees who, I, if employed throughout the financial year, received remuneration for that year, which in the aggregate was not less than 1 crore and 2 lakh rupees. Roman 2. If employed for a portion of the fiscal year, received remuneration for any portion of that year at a rate not less than 8 lakh and 50,000 rupees per month. Roman 3. If employed throughout the fiscal year or part thereof, received remuneration in that year that, in the aggregate, or as the case may be, at a rate that, in the aggregate, is greater than that drawn by the managing director or whole-time director or manager, and holds not less than 2% of the equity shares of the company by himself or jointly with his spouse and dependent children. The above statement shall also indicate I. Designation of the employee, Roman 2, remuneration received, Roman 3, nature of employment, whether contractual or otherwise, Roman 4, qualifications and experience of the employee, v. date of commencement of employment, Roman 6, the age of such employee, Roman 7, the last employment held by such employee before joining the company, Roman 8, the percentage of equity shares held by the employee in the company within the meaning of clause Roman 3 of subrule 2 above. And Roman 9, whether any such employee is a relative of any director or manager of the company, and if so, name of such director or manager. Employees posted and working in a country outside India, not being directors or their relatives, who earn more than 60 lakh rupees per financial year or 5 lakh rupees per month, as the case may be, shall not be circulated to the members in the board's report. But such particulars shall be filed with the Registrar of Companies, along with the financial statement and board reports, and such particulars shall be made available to any shareholder on a specific request made by him in writing before the date of such annual general meeting, wherein financial statements for the relevant financial year are proposed to be adopted by shareholders, and such particulars shall be made available by the company within 3 days from the date of receipt of such request from shareholders. That wraps up our session on managing and deciding pay for top managers and directors under the Companies Act, 2013. We've explored the key rules around Section 197, including the limits on how much companies can pay their directors, what happens when companies have insufficient profits, and the importance of proper disclosures in the board's report. Remember, understanding these regulations is crucial for ensuring transparency, fairness, and compliance in corporate governance. If you have any further questions or need clarification, feel free to reach out. Thank you for your attention today, and I look forward to seeing you in our next session. Session 4. Hello participants, welcome back today. We're diving into managerial remuneration under Schedule V, Part Roman 2 of the Companies Act. To give you a clear understanding, let's break it down step by step. First, we have Section I, remuneration by companies with profits. Here, if a company earns a profit, it can pay its executives according to the rules laid out in Section 197. Now, moving on to Section Roman 2, remuneration by companies with no/inadequate profits. This is where things get interesting. Even if a company isn't making enough profit, it can still pay its managerial personnel. The amount depends on the company's effective capital, and here's how. For companies with less than rupee 5 crore, the limit is rupee 60 lakhs for managerial personnel and rupee 12 lakhs for other directors. If the capital is rupee 5 to 100 crore, the limits increase to rupee 84 lakhs and rupee 17 lakhs respectively. For companies with rupee 100 to 250 crore, it's rupee 120 lakhs and rupee 24 lakhs. And for companies with over rupee 250 crore, it's rupee 120 lakhs plus 0.01% of the excess capital for managerial personnel and rupee 24 lakhs plus 0.01% for other directors. But that's not all. With a special resolution, these limits can be raised further, and if the period is less than a year, the remuneration is prorated. Next, in Section Roman 3, we look at special circumstances. Here, companies that don't have enough profits can still pay higher remuneration to professionals if they meet certain criteria, such as not holding significant shares or being related to directors. As we continue, we'll also explore important sections like net profit calculation under Section 198, the recovery of remuneration under Section 199 in case of fraud, and the rules for compensation for loss of office under Section 202. Let's begin. Now, we come to an important section on managerial remuneration under Schedule V, Part Roman 2. Section I, remuneration by companies having profits. A company that makes a profit in a fiscal year may pay remuneration to its executives in accordance with Section 197. Section Roman 2, remuneration by companies having no profits or inadequate profits, where in any financial year during the currency of tenure of a managerial person or other director, a company has no profits or its profits are inadequate, it may pay remuneration to the managerial person or other director not exceeding the higher of the limits in this table. Where the effective capital is negative or less than 5 crore, limit of yearly remuneration payable shall not exceed in case of a managerial person, Rs. 60 lakhs, limit of yearly remuneration payable shall not exceed Rs. in case of other director. 12 lakhs 5 crore and above, but less than 100 crore, limit of yearly remuneration payable shall not exceed in case of a managerial person, Rs. 84 lakhs, limit of yearly remuneration payable shall not exceed Rs. in case of other director. 17 lakhs 100 crore and above, but less than 250 crore, limit of yearly remuneration payable shall not exceed in case of a managerial person, Rs. 120 lakhs, limit of yearly remuneration payable shall not exceed Rs. in case of other director. 24 lakhs 250 crores and above, limit of yearly remuneration payable shall not exceed in case of a managerial person, Rs. 120 lakhs plus 0.01% of the effective capital in excess of Articles 250 crores, limit of yearly remuneration payable shall not exceed Rs. in case of other director. 24 lakhs plus 0.01% of the effective capital in excess of Articles 0.1% of the effective capital in excess of Rs. 250 crores 24 lakhs plus 0.01% of the effective capital in excess of Rs. 250 crores. If a special resolution is passed by the shareholders, the above limits can be increased. It is hereby clarified that for a period less than 1 year, the limits shall be prorated. B. In the case of a managerial person or other director who is functioning in a professional capacity, remuneration as per item A may be paid. If such managerial person or other director is not having any interest in the capital of the company or its holding company or any of its subsidiaries directly or indirectly or through any other statutory structures, and not having any direct or indirect interest or related to the directors or promoters of the company or its holding company or any of its subsidiaries at any time during the last 2 years before or on, or after the date of appointment, and possesses graduate-level qualification with expertise and specialized knowledge in the field in which the company operates, provided that any employee of a company holding shares of the company not exceeding 0.5% of its paid-up share capital under any scheme formulated for allotment of shares to such employees, including employees' stock option plan, or by way of qualification, shall be deemed to be a person not having any interest in the capital of the company. The Schedule V, Part Roman II, also prescribes certain conditions and additional disclosures to be made in the explanatory statement to the notice of the general meeting, where remuneration is required to be paid in accordance with Schedule V. With regards to remuneration in special circumstances, Section Roman III of Schedule V specifies special circumstances in which companies with no or insufficient profit can pay remuneration to their managerial personnel in excess of the amount specified in Section Roman II of Schedule V above, without the approval of the central government. Let us now discuss the calculation of net profit for the purpose of managerial remuneration. Section 198. Section 198 of the Companies Act 2013 specifies the method for calculating a company's net profits for any fiscal year for the purposes of Section 197. Subsection 2 specifies the amounts for which credit is to be granted, while subsection 3 specifies the amounts for which credit is not to be granted when calculating net profit. Similarly, subsections 4/5 specify the amounts to be deducted/not deducted when calculating net profit. Coming to the recovery of managerial remuneration, in certain cases, Section 199 of the new Act contains a new provision in this regard. It provides for the recovery of remuneration, including stock options, received by the specified managerial personnel if the benefits provided to them are found to be greater than what is reflected in the restated financial statements. It states that, without prejudice to any liability incurred under the provisions of this Act or any other law currently in force, if a company is required to restate its financial statements due to fraud or non-compliance with any requirement under this Act and the rules made thereunder, the company shall recover from any past or present managing director or whole-time director or manager or chief executive officer, by whatever name called, who, during the period in question, received the remuneration, including stock option, in excess of what would have been payable to him as per restatement of financial statements. Now, let us discuss the fixing of remuneration limit under Section 200. In cases where the company's profits are insufficient or non-existent, a company may fix the remuneration within the limits specified in the Act at such amount or percentage of profits of the company as it may deem fit, and while fixing the remuneration. While doing so, the company must consider a. The company's financial position, b. The remuneration or commission drawn by the individual concerned in any other capacity, c. The remuneration or commission drawn by him from any other company, d. The individual's professional qualifications and experience, e. Such other matters as may be prescribed, according to Rule 6 when granting approval for item E of Section 200, the company must consider the following factors. 1. The company's financial and operational performance over the previous 3 fiscal years. 2. The relationship between pay and performance. 3. The the principle of remuneration proportionality within the company, ideally through a rating methodology that compares the remuneration of directors to that of other executive directors on the board and employees or executives of the company. 4. Whether the remuneration policy for directors differs from the remuneration policy for other employees, and if so, why. 5. The director's securities, including options and details of shares pledged as of the end of the previous fiscal year. Now, we come to the discussion on the compensation for loss of office of managing or whole-time director or manager, which falls under Section 202. It is a replica of Section 318 of the Companies Act of 1956. Section 202 states that a corporation may pay a managing or full-time director or manager, but not any other director, as compensation for loss of office, or as consideration for retirement from office, or in connection with such loss or retirement. However, in the following circumstances, no payment will be made. A. Where the director resigns from his office as a result of the company's reconstruction/amalgamation and is appointed as the managing or full-time director, manager, or other officer of the reconstructed company / of the resulting company from the amalgamation. B. Where the director resigns from his office for reasons other than the company's reconstruction/amalgamation. C. Where the director's office is vacated due to disqualification. D. Where the company is being wound up as a result of the director's negligence or default. E. Where the director has been guilty of fraud or breach of trust, or gross negligence or mismanagement of the company's or any subsidiary company's or holding company's conduct of affairs. F. Where the director has instigated or has taken part directly or indirectly in bringing about the termination of his office. Any payment made to a managing or whole-time director or manager under subsection 1 shall not exceed the remuneration which he would have earned if he had been in office for the remainder of his term, or for 3 years, whichever is shorter, calculated on the basis of the average remuneration actually earned by him during the 3 years immediately preceding the date on which he ceased to hold office, or where he held the office for a lesser period than 3 years during such period. Provided, however, that no such payment shall be made to the director in the event of the company's winding up, whether before or at any time within 12 months after the date on which he ceased to hold office, if the assets of the company on the winding up, after deducting the expenses thereof, are insufficient to repay to the shareholders the share capital, including any premiums contributed by them. However, subsection 4 of Section 202 does not prohibit the payment of remuneration to a managing or full-time director or manager for services rendered to the company in any other capacity. That wraps up our session on managerial remuneration under Schedule V, Part Roman II of the Companies Act. We've covered the key sections, starting with remuneration for companies with profits, then moving to how companies with no or inadequate profits can still compensate their managerial personnel. We also discussed special circumstances where higher remuneration can be granted without needing government approval. Remember, these rules ensure that companies balance compensation with fairness while staying compliant with regulations. The details we've gone over today, especially the limits and criteria, are crucial for understanding how corporate governance controls executive pay. In our next session, we'll explore another essential aspect of corporate governance, so stay tuned. Thank you for your attention, and feel free to reach out if you have any questions. Session 5, welcome back, everyone. In this final session, we'll be wrapping up by looking at some key topics related to managerial remuneration and corporate compliance. We'll talk about how companies can apply to the central government for approvals under the Companies Act and highlight important changes that have made paying managerial staff easier, with fewer approvals needed. We'll also cover secretarial audits, which are an important tool to make sure companies are following the rules and keeping good governance practices in place. By the end of this session, you'll have a clear understanding of how these processes work and how they help companies stay compliant with the law. Let us now discuss the application made to the central government. Section 201 of the Companies Act, 2013 states that before any application is made by a company to the central government under any of the aforementioned sections, a general notice to the members indicating the nature of the proposed application shall be issued, and such notice shall be published at least once in a newspaper in the principal language of the district in which the company's registered office is located, and at least once in English in an English newspaper circulating in that district copies of the notices, along with a certificate from the company attesting to their proper publication, must be attached to the application. The central government mandated that all applications to the central government under Chapter 13 be submitted in Form No. Mr. 2 and shall be accompanied by fee as may be specified for the purpose. Let me now briefly run through some of the key points we have discussed so far. The new Act has significantly liberalized the provisions governing managerial remuneration, subject to adequate shareholder disclosures. The need to seek approval from the central government has been significantly reduced. The following is a summary of the changes made. 1. No central government approval is now required for making salary payments to non-executive directors in the form of monthly payments as long as they are within the limits specified. 2. Reappointment of a managerial person cannot be made earlier than 1 year before the expiry of their term, rather than 2 years, as per the existing provision of Section 317 of the 1956 Act. 3. Any director who receives a commission from the company and is a managing director or whole-time director of the company may also receive remuneration or a commission from any holding company or subsidiary company of such company, subject to the company disclosing such compensation or commission in the board's report. This differs from the provision in the Companies Act of 1956. Furthermore, the directors are not permitted to accept remuneration or commission from any other company, including associate companies. 4. Independent directors may be paid a higher sitting fee than other directors. Stock options are not granted to independent directors. They may only be compensated in the form of sitting fees, reimbursement of expenses for participation in board and other meetings, or profit-related commissions approved by the company's members. 5. Every listed company will be required to disclose in the board's report the ratio of each director's remuneration to the median employee's remuneration, as well as any other information prescribed by the central government through the rules. Given the widespread debate in the country and abroad about excessive managerial pay, the purpose of enacting this provision appears to be to inform shareholders about the extent of pay disparities between employees and directors. 6. Any premium paid by a company on behalf of its managing director, whole-time director, manager, chief executive officer, chief financial officer, or company secretary for indemnifying any of them against any liability in respect of any negligence, default, misfeasance, breach of duty, or breach of trust for which they may be guilty in relation to the company, shall not be treated as part of the remuneration payable to such personnel, unless such personnel are employees of the company. 7. No central government approval is required for remuneration payable to any director in any other capacity if such services are of a professional nature and the Nomination and Remuneration Committee, or Board of Directors, is of the opinion that the person possesses the necessary qualification for practice of profession. 8. In the event of no or insufficient profit, the conditions under which the company can pay remuneration to managerial personnel have been modified. Finally, let us go over the secretarial audit. Secretarial auditing is a type of compliance audit that is performed as part of an organization's overall compliance management. The secretarial audit is an effective tool for managing corporate compliance. It aids in the detection of non-compliance and the implementation of corrective actions. Secretarial auditing is a process by which an independent professional checks compliance with the provisions of various laws and rules/regulations/procedures, maintenance of books, records, and so on, to ensure that the company has complied with the legal and procedural requirements and also followed the due process. It is essentially a mechanism for monitoring compliance with stated laws' requirements. Given the growing importance of corporate governance, Section 204 of the Companies Act of 2013 requires every listed company and such other class of prescribed companies to annex a secretarial audit report provided by a company secretary in practice to its board's report. The central government has prescribed the following other types of companies through rules. A. Any public company with a paid-up share capital of 50 crore rupees or more. B. Any public company with a turnover of 250 crore rupees or more. It is the company's responsibility to provide all assistance and facilities to the company secretary in practice for auditing the company's secretarial and related records. The board of directors shall explain in detail any qualification, observation, or other remarks made in the secretarial audit report in their report. Secretarial auditing is an objective, independent assurance designed to add value and improve an organization's operations. It contributes to the achievement of the organization's goals by bringing a systematic, disciplined approach to evaluating and improving the effectiveness of risk management, control, and governance processes. That brings us to the end of our final session. We've covered important points today, including the application process to the central government for managerial remuneration, the changes that make paying directors and executives easier, and the role of secretarial audits in ensuring companies stay compliant with legal requirements. These concepts are key to understanding how corporate governance works in practice and how companies manage their compliance with both pay regulations and broader governance processes. Thank you for your participation throughout these sessions. If you have any further questions, feel free to reach out. Best of luck in applying these principles to your own corporate governance journey.